Been said that you can't save your way to wealth, and historically low interest rates of the last decade, they definitely bear this truism out. Those who kept money parked in a CD or money market account between 2010 and 2017 may find that these funds have far less purchasing power today than when they were first deposited.
Hey there, welcome back to Finance Zoo channel. It's often said that you can't save your way to wealth, and the historically low interest rates of the last decade have truly reinforced this wisdom. Today, I'm excited to discuss the reason why you should invest. It's a topic that can change the trajectory of your financial journey. So let's dive right in and discover the incredible potential that awaits you. Phil Town, an experienced investor and financial educator, provides valuable insights and guidance to help you understand the compelling reasons why you should invest.
Those who kept money parked in a CD or money market account between 2010 and 2017 may find that these funds have far less purchasing power today than when they were first deposited, number one, and second, they're hardly any bigger than you started with, all due to the growth-killing combination of low returns and moderate inflation. First, you guys, compounding is incredibly powerful. Albert Einstein famously has said that the power of compounding mathematically is one of the things he never really figured out.
That's right. As Phil Town said, money parked in a CD or money market account during this time has likely suffered from reduced purchasing power. The culprit? It's the combination of low returns and moderate inflation. This statement highlights a critical point about the impact of not investing your money wisely. When you leave your funds in low-yield accounts or assets that don't keep pace with inflation, you essentially let the value of your money erode over time. This is where the importance of investing becomes clear. So, why should you consider investing? Let's break it down. 1. The power of compound interest. Investing is not just about parking your money somewhere, but actively growing it. Compound interest is the magic ingredient here. It's the concept of your money earning interest on your initial investment and then earning interest on that interest, creating a snowball effect. Think of it as a tree bearing fruit. Each year, the tree produces more fruit, and you collect a portion of it. This continuous cycle can lead to significant financial growth.
All the money inside Apple creates this incredible compounding power. It's a stunning thing what happens when you double money over and over again. It just gets so huge you can't believe it. $1,000 doubled just 20 times. $1,000 doubled 20 times is $1 billion. $1,000 doubled just 10 times is $1 million.
2. How does compound interest work? Phil Town emphasizes the significance of compound interest. It's truly remarkable how money grows when it continuously doubles over time. To put it in perspective, let's break down how compound interest works using Apple as an example. Apple's return on investment equity is a remarkable 30% per year, which means that if you invest $1,000, you'll have $1,300 of equity in Apple after 1 year. Now, the magic of compound interest comes into play. In the next year, they're achieving a 30% return on the original $1,000, an additional $300, and 30% on the new $300 from the previous year, which is another $90. As you can see, the 30% return is applied to the growing sum of money inside Apple, creating an incredible compounding effect. Think about this. $1,000 doubled just 20 times, which amounts to $1 billion, and even doubling it only 10 times results in $1 million. This showcases the power of compounding. To put it into perspective, Apple's money grows by compounding at 30% yearly. This means they double their money every 2.5 years. So in 5 years, the initial $1,000 becomes $2,000. In 10 years, it becomes $4,000, and this growth continues exponentially. Over time, these assets reach a critical mass, and even a small investment in Apple in 2000 would now be worth millions. This is the astounding compounding power of investing in stocks. 3. Where to consider investing. Now that we understand the why and how, let's explore the where. There are various avenues for investment. 1. Stock market. Investing in stocks offers the potential for high returns. However, it's crucial to diversify your stock portfolio to manage risk. 2. Bonds. Bonds provide a more stable, fixed-income investment option. 3. Real estate. Real estate can generate rental income and property value appreciation over time. 4. Mutual funds. These funds pool money from multiple investors to invest in diversified securities. 5. Retirement accounts. Maximize contributions to 401ks or IRAs for tax advantages and long-term growth. To manage risk, consider diversifying your investments. Diversification is a fundamental strategy that can significantly enhance your investment portfolio and protect your financial well-being. By doing so, you mitigate risk by not putting all your eggs in one basket. It minimizes the impact of poor-performing investments on your overall portfolio, helping you maintain a more balanced risk-return profile. Diversification enables you to achieve a sustainable, resilient financial position over the long term, aligning with your financial goals and risk tolerance. It's not just a short-term strategy, it's a smart, long-term investment practice, ensuring financial security while pursuing prosperity. Before we end this discussion, let's discuss the disadvantages of not investing. On the flip side, when you choose not to invest, you are essentially letting your money languish, and here's why it matters. 1. The eroding impact of inflation. Inflation is like a silent but persistent thief that gradually devalues the money you worked hard to save. Over time, the purchasing power of your savings diminishes. Simply put, your money today won't buy you as much tomorrow. This can be disheartening and demotivating. The dream vacation, the home you desire, and the education you want for your children, all of these aspirations could slip further out of reach. 2. Hindering your financial goals and aspirations. When your money isn't actively growing, it can hinder your ability to achieve your financial goals and aspirations. Whether you're saving for a comfortable retirement, your children's education, or a new business venture, not investing means these dreams may remain distant fantasies. The years pass, and your goals seem to move further away instead of getting closer. The good news is that it's never too late to start. Today is the best day to begin. Understand that while the past is gone, your future is an open book waiting to be written. By choosing to invest, you take control of your financial destiny. You allow your money to grow, to work for you, and to align with your aspirations. Every dollar you invest is a step closer to securing your dreams. Think of it as an investment in yourself and your future. Just as a seed grows into a mighty tree, your investments have the potential to flourish over time, creating the financial security and freedom you desire. So, don't let the fear of the unknown or the misconception that you need a lot of money deter you. Start small if you must, but start today. With time, patience, and the power of compound interest, your financial landscape can transform. Your goals become achievable, and the life you envision becomes more than a dream. Remember that the earlier you start investing, the more your money can benefit from compound interest, increasing your potential for financial success. Think of it as planting a tree. The ideal moment to start was yesterday, but the second best time is undeniably today. Investing early gives your money the gift of time to grow and multiply. Compound interest ensures that each dollar you invest has the potential to work harder and generate even more wealth for your future. It's a powerful tool that can turn small, regular investments into substantial financial success. So don't wait for the perfect moment, because it may never come. Start today, no matter how small your initial investment may be. Your financial future will undoubtedly thank you for your forward thinking and determination. By investing in your dreams and financial goals, you are taking a significant step towards securing the prosperous future you deserve. Remember, the key to building wealth is not just having money, it's making your money work for you. Start now and watch your financial aspirations become a reality. If you'd like more insights into achieving financial independence, check out our previous video on how to become financially independent. The link is in the description below. Thanks for joining me today on Finance Zoom. Feel free to share your insights in the comment section below. Remember to give this video a thumbs up, share it with others, hit the subscribe button for more engaging content, and see you in the next video.